Hello guys, welcome to this class. In our last class, we touched on market structure. I showed you what a buy candle means, what a sell candle means. I taught you about supply and demand zones. We talked on order blocks. So today I'm going to be teaching you my entry models. And these entry models, they are what I follow whenever I want to take trade any day on the Forex market. So once I see my entry model, it serves as a confirmation for me to enter any buy or any sell position. Let's get right into what we have today. So here's a trade I took. This is volatility 25 1x. This is a 4-hour time frame. The trade was actually this one right here. Okay, this position. I entered a buy from this place and it has hit my take profit region. Now, why did I enter this trade? Why did I enter this buy trade? First off, I saw this big breaker structure over here. So after I saw the breaker structure, I knew price is going to come to react to a particular zone, a particular demand zone right here. And so I have to look for what I use as confirmation for me to enter this trade right here. In our last class, I told you about inducement and liquidity. And so we are going to be going in depth and more examples about that. So these are my entry models. These are the two scenarios I expect to see whenever I want to enter a buy. Whenever I want to enter a buy position in the Forex market, these are the entry models for buy that I'm looking out for. And these are the two entry models for sales whenever I want to enter a sell position in the Forex market. Now, this works both on Forex synthetics market and Forex currency markets. You get me? So it doesn't matter whether you trade synthetics alone or you trade both the currency market. These are the two entry models that I use. So I'm going to be showing you lots and lots of examples. Now let me actually break down exactly what this model means. Let me break down exactly what this model means. So before I enter a buy position, I want to see this place get taken out. It is called a sweep of liquidity. I want to see a sweep of liquidity by the side of that other block. I want to see a sweep of liquidity. I want to see the first break of structure, a complete pullback, and another break of structure. This first break of structure is called a transactional liquidity. Transactional liquidity is being taken out. Now, I don't just take trade immediately I see this first break of structure. I want to see a pullback and another break of structure. This second break of structure will now create an area for structural liquidity. So what do I expect price to do? I expect price to come here. I expect price to come back here, take out this low and tap into any area inside here. I can enter from this structural liquidity point, or I can find a good order block here using a Quasimodo entry or just using a normal order block. But any zone under this structural liquidity is valid. Now, like I said earlier, liquidity is what moves the market. Have this at the back of your mind. Liquidity is what moves the market. And inducement as traps. Inducement are traps that tricks you to enter a trade, to enter a particular trade in the wrong zone. In the wrong zone. Now, having that at the back of your mind, you need to be, before you enter a trade, you need to ask yourself, where is the trap around this place? Where is the inducement around this place? Inducement need to be created for liquidity to be taken. Inducement need to be created for liquidity to be taken. So when price traps you, when price tricks you to enter a trade and later comes back and hit your stop loss or kick you out of that market, you have been used as liquidity in the market. All right. So having this at the back of your mind, before you enter any trade, you need to find a zone of inducement. You need to find a zone of inducement, a point where liquidity is supposed to be taken out. If there's no liquidity, if there's no inducement before your zone, it means your zone may not be valid. It means your zone may not be valid. So price must take out an inducement before moving up to the upside or buying up. Also, price must take out an inducement, wait for price to take out an inducement before selling. So if you want to enter a sell position, wait for price to take out the inducement in that area before you enter the sell position. Likewise, buying. Now, this is the entry model 1 for buy scenarios. Now, this is my entry model for the entry model 2 for a buy scenario. Now, just to be clear, I wasn't the one that formed this. I didn't create this entry model. All right. My mentor taught me, and so that's what I'm teaching you. I have a mentor that taught me this. So I didn't create it from scratch. I wasn't the one that figured it out that this is the entry model that works. So I have a mentor, and I suggest you should get one too. Now let's proceed. This is the entry model number 2, the type B entry model. This is the type A setup. This is the type B entry model. And what this simply means is there should be a sweep. There should be a sweep. When you see your sweep, then price should create an inducement, a pullback. After price create a pullback before breaking structure, that pullback is a potential area for inducement. Any pullback price created before actually breaking structure, that pullback is a potential inducement area. So when I see this kind of thing, you notice that this one have one breaker structure, this one have two breaker structure. The one with two breaker structure, there was a pullback, then the second breaker structure. While the one with one breaker structure, there was just a pullback before the breaker structure. The pullback happened before the breaker structure. So we are waiting for price to come, take out price to come in like this, take out this inducement area, tap into our zone, then buy up. This is what we are waiting for. And likewise, the sell scenario. I want to see a sweep, liquidity sweep, then the first break of structure, a pullback, reasonable pullback, then the second break of structure. So what do I expect price to do? I expect price to come back, take out this structural liquidity here, tap into our zone inside here, then continue the sell movement. Same here is in type B for the sell scenario. I expect price to come back, take out this inducement it created before breaking structure, then continue the sell movement. So I want to give you a moment to look at what I drew here. You can screenshot it, right? You can screenshot it can screenshot this stuff. Let me give you a minute or some seconds to screenshot this. Learn it. Let me give you some seconds for you to digest what I just said. All right. So we are going to be looking at these scenarios in the chart. I'll be showing you lots of examples. Now let's go to the real chart. Let's go to the live chart. So like I said, I saw an overall break of structure, but I know price is going to pull back to a certain demand zone. And now what validated this setup for me was this. I saw this sweep. Then I saw the first break of structure with a body. You can see this thing break structure with a body, not with a wick. So I saw the first break of structure. I saw the pullback. Then the second break of structure. So what do I expect price to do? I expected price to come, take out this structural liquidity, tap into my demand zone, tap into my entry, then buy up. And that's exactly what price did. Because the Forex market is fractal in nature, whatever happens in the 4 hour also happens in the 1 hour time frame. It's the same thing that happens in the 30 minutes time frame. Even if you go to 1 minute or the seconds time frame, it's still the same thing you see there, the same market structure playing out. So with that in your mind, this entry model that I just showed you can also happen in the 30 minutes time frame. It can also happen in the 30 minute time frame. But I would suggest you use it most of the time for confirmation from the 30 minutes time frame. You mark your chart from the 4 hours, take your entry from the 4 hours. Then if you want further confirmation, you can go and look for that entry model in the 30 minutes time frame. So here's what we should do. Now let's say as price tapped into this zone, I went to 30 minutes and I was looking for confirmation. Let's see if there was any confirmation for us in this zone. Let me delete this big one so that my screen will be clear. All right. So what can you see here? Can you see that our entry model again? There was a sweep. Price was selling, then created this sweep and tapped into our 4 hour demand zone, our entry zone from our 4 hour. Then price tapped into it, then break structure the first one. After breaking structure, it came back, pull back, then broke structure the second one. So what do we expect price to do after the second break of structure? We expect price to come, take out this structural liquidity, tap into our zone and buy up. And that's exactly what happened. So you can use this as a confirmation and increase your risk to reward, increase your win rates. So you can enter from this Quasimodo right here, just below the structural liquidity, or you can enter from this other block right here. I taught you about other block. There's this nice sell candle before the buy candle with an impulsive move that break a structure. So it's very clear. It was very, very clear. The confirmation was very clear. So that's it. And what the price did, after price took out the structural liquidity, tapped in and buy up. So you can just target 1:3 RR, 1:3 risk to reward on this. You can just target 1:3 RR on this. And what does this mean? 1:3 RR simply means if you are risking $1, if price should go against you, that is to say, price come back here and hit your stop loss, it means you will lose $1. But if price go to your favor, that is price played out nicely, it means you are going to make $3 profit. And so this is the position to I suggest you should stick with 1:3, except you are entering with confirmation. Okay, so this stuff right here is the position 2. It will show you your stop loss level, to show your entry level, and to show you your take profit region. So let me use this to mark out, let me use this horizontal line to mark out our take profit region. You can see this is where this green thing stop. So I've marked it out. This is where the entry is from this point. I've marked it out. And this is where the stop loss is. The stop loss is just below this your other block, this strong low here, a little bit below it. Now, if I give you signal, or maybe you want to enter your trade, how do you enter that trade? You just come here. This is the entry, this line here. You move straight to the left. You are going to see the line here showing you your entry. Just follow this entry line to the left here. You see it 53, you see 57, 32, 92.99. That's your entry. You go and put it on your MT5, on your MT4. For this one now, we are buying, so you will set buy limit. If you are selling, you will set sell limit. When you go to your MT5 or MT4, you are going to see it when you want to enter any position. You see sell limit, you see buy limit. So this buy limit, this place will be the entry. When you click on buy limit, this place will be your entry. This place will be your entry. 57, 32, 92. That will be your entry. Then here will be your stop loss. You put your stop loss, move to the right here. You will see it. Your stop loss is, the red one is always your stop loss. Okay, so you can see 57,1505.88. That will be your stop loss. You put it. Then your take profit region. Your take profit region is the green one here. You see it, 57,8605.382. And that's how you enter these trades. That's how you enter these trades. So once you set your entry, your stop loss, and your take profit region, when you set it on your MT5 or your MT4, whatever you're using to trade, it's going to play out automatically. You don't need to be watching your chart and be monitoring anything. You just need to come and check after some hours and see if you have hit profit or you've hit stop loss. That's just it. It's going to close automatically. So now let's say we are targeting this 4-hour high. We are targeting this 4-hour. Let me delete this to make my chart clear. So let's say we are targeting from the 4-hour. We are targeting a risk to reward of 1:3 RR. Let's say we are targeting a risk to reward of 1:3 RR. So as you can see, this is 1:3. You can see where they wrote it, a risk to reward ratio 3. So this is 1:3 RR. And with our confirmation on 30 minutes, you can see where it is. So you can decide to target the same high of your you can decide to target the same high of your 4 hours after using confirmation on the 30 minutes. And you see how, let me mark this 4 hour. This is our take profit region for our 4 hours. So if I go back to 30 minutes now, so as I go back to the 30 minutes time frame now, because of your confirmation on the 30 minutes, you have already increased your risk to reward ratio to 8.8. That is, you are losing $1 to make $8. You have increased your risk to reward ratio to 8 RR, almost 9 RR. All right. So this is the importance of confirmation entry. This is the importance of confirmation entry. And what are you looking for using as confirmation? The same entry model, just as I told you. There's the sweep, the first break of structure, the pullback, the second break of structure, price will come back, take out the structural liquidity, and go up to a direction. So this entry model works, guys. Let me show you screenshot from my archives of all the trades I took in the past. I'll show you the one that hits SL, all right? So I'm not hiding anything from you. I'll show you everything, both the one that hit profit and the one that hit SL. I'll show you everything. Let me start with this one. You can see there was a sweep, there was the break of structure, the pullback, and the second break of structure. Price took out this structural liquidity, tapped into our zone. But before selling, price weak toss out. So if our stop loss is a little bit higher, we will still be in this trade. But all the same, you can see that this wicked me out. So I took a loss on this. This is a trade I took. This is on Euro AUD. So the reason why I was just catching the sales and the buy at the same time was because market was consolidating. Market was ranging. And that's why I'm doing this. On a pure uptrend or downtrend, on a downtrend, I only look for sales. On an uptrend, I only look for buys. Now, you can see how this entry model keeps playing out. There was a sweep. After sweep, there was the break of structure, the pullback, the second break of structure. Price came back, took out the liquidity, tapped into the zone, and fell. The same thing happened here. Price took out liquidity, broke structure. After breaking structure, it came, retraced, then broke structure again. So what the price came back, took out this structural liquidity, tap into the zone, and sell. A lot of examples to show you. Let's check if this trade is valid. This is Euro card. This is a screenshot I took on Euro card, 1 hour time frame. I saw this sweep. Why did I take this screenshot? I saw this sweep. I saw a break of structure. I saw a pullback and another break of structure. So I was expecting price to come back, take out this structural liquidity, tap into my zone, and buy up. All right, so I think this is the same thing. This one is USD card, 1 hour time frame. And why did I take this trade? I saw the sweep. I saw the first break of structure. Notice that this one, this week, I did this break of structure happened over here. All right, it broke structure with a candle here, not this week. I don't use week to show my break of structure. So this break of structure actually happened over here. So this like this is the first break of structure. Price came back, pulled back, and broke structure again with a body. I'm looking at the body, not the wick. So after price broke structure with the body, price came back, took out this low from the structural liquidity, this second break of structure, took it out, tap into our buy entry here, tap into this other block, then buy up. This is it. That was on USD card. A lot of examples to show. This one is on synthetics market. The previous one I showed you was currency. So this will show you that this entry model works both on synthetics and currency pairs. All right. So this one is volatility 10 index, 1 hour time frame. I saw the sweep, then I saw the break of structure, price pull back, broke structure the second time, came, took out this structural liquidity, tap into our zone, and sell down. Some people will be asking, why did I mark this place? This was the other block where the price took out liquidity in the first time. That was why I marked it out. So it's my entry model. They call it Quasimodo entry model. Now, if I didn't see this, I can find a good other block that is close to this structural liquidity. I can find a good other block that is close to this structural liquidity and take the sell from here. All right. And you can see how price played out nicely. This one is on Euro GBP. I don't trade this pair. This entry was clear, but I don't trade this pair. I don't trust this pair. This pair is just. This is AUD US dollar, 5 minutes time frame. You can see this in works on 4-hour time frame or 2-hour time frame, 1 hour, even the minutes time frame. This is 5 minutes time frame. I saw this entry. Okay, so what did I see? I saw the sweep, I saw the break of structure, I saw the pullback, and second break of structure. Price came back, took it out, tapping, and buy up. That was it. Look at this one now. This is on Euro card, that is EU card, right? Price took out liquidity here, then broke structure. After breaking structure, a pullback and break structure again. All right, so when price came back, it was just ranging here. It hasn't taken out this structural liquidity. And what did it do? It came back, took out the structural liquidity, tapped into this zone, and buy up 1:3 RR. You see how I love taking my risk to reward ratio of 1:3. You can see immediately price took out this 1:3 RR, it just reversed. So if you have been targeting big, you may hit stop loss. That's how I would suggest you start with 1:3 RR until you become very profitable. This is on AUD, USD, Australian dollar versus US dollar. As you can see, there was the first break of structure, there was the sweep, then the break of structure, price pullback, broke structure again, price came back and tapped into the zone. Now, why the price take this out? I told you any pullback before the break of structure is a potential inducement area, and so price took out that pullback that happened there, tap into this other block and sold down. I see this is on volatility 100 index. This is 15 minutes time frame. And why did I take this sell? There was the sweep, first the sweep, then the break of structure. But before breaking structure, price created this pullback. And this pullback, I told you any pullback before the break of structure is an inducement area. So price broke structure, created this inducement, broke structure, came back, and I was expecting price to take out this inducement, tap into this zone, and sell 1:3 RR. Same thing here. I saw the sweep, the break of structure. After break of structure, the pullback, another break of structure. So I was expecting price to come, take out this structural liquidity, tap into here, and sell. Now you can, if you look at this one, there was the break of structure, and there was this sweep, the liquidity sweep, and the break of structure over here. But price did not create any inducement. There was no clear visible inducement area. And so whenever I do not see inducement area, it means this zone here is meant to be the inducement area. So my entry was just at the bottom of that zone where many people will be entering buy from this place. But my entry was in their stop loss region. So after price weak them out, price is going to sell, and my target was 1:3 RR. So here's another trade, volatility 50 index. I saw the sweep, then the break of structure, the pullback, then the second break of structure. Price tapped into this, price took out this structural liquidity, tap into here, and it's selling down. So that's how I've been marking it, guys. That's how I've been marking it. The same thing with this one. I saw the sweep, the break of structure, the pullback, then the second break of structure. I was expecting price to come, take out this structural liquidity, tap into here, and sell. So this scenario happened both in sells and buys. You can see that former one I showed you. This one here, you can see how price played out. See this one, this volatility 15 index, 15 minutes. You can see how it played out nicely. You can see how it played out. This second one tapped in. You can see this one I showed you that doesn't have any inducement. This one, you can see how I showed you this one. I took the screenshot. And you can see how it tapped in, took out this place, tapped in nicely, and sold down. Clean 1:3 RR. This one, jump 10 index, also played out. Look at the jump 10 index. You can see how it's playing nicely. If it's 1:3 RR, I should be out of the market from here. But I think I was targeting low to take out this low. But then with 1:3 RR, I'm okay. This is the volatility 75 index 15 minutes. I showed you the volatility. This one, volatility 75 index 15 minutes. That was it here. Price always respect this thing most of the time. Not, you don't have a win rate of 100%. I have to be honest with you. But the win rate is 70, 75%, 80% win rate. Coupled with your risk to reward ratio and your risk management, you are going to be very profitable. So this is why I'm going to call it a day, guys. I don't want this class to be very long. I am Divine Akachukwu. You can chat me up. So that I can save your contacts. And if you like, you can follow me on other social handles. Please make sure you subscribe to this YouTube channel, because I'm going to be dropping valuable content on this channel. So make sure, please subscribe so that I can be the first or one of the first to see new videos that I drop every week.